All right, let's jump right into this explainer. We're decoding the, quite frankly, surprising Q1 2026 financial performance across the North American food distribution sector. Now, if you follow this space, you already know it's a massive, super complex industry. But what went down this recent quarter? It's basically a masterclass in strategic maneuvering.
So here's the central paradox we're unpacking today. How exactly did these companies crush their earnings expectations despite facing some really massive macro-environmental headwinds? I mean, we're talking about a period fraught with severe challenges, right? Yet the major players didn't just survive, they absolutely thrived. And it all came down to some fascinating plays in tech, market positioning, and M&A.
Here's the roadmap for today's explainer. We'll cover the sector overview and headwinds, look at growth drivers like tech and M&A, check in on the heavyweights, Cisco and PFG, dive into UNFI's network optimization, spotlight Chef's Warehouse, and wrap up with the 2026 financial outlook.
All right, Section 1. Sector Overview and Headwinds, Navigating the Storm.
Right out of the gate in early 2026, distributors had to navigate a pretty brutal operating environment. Looking at the latest Solomon Partners sector update and individual company reports, they were hit with severe weather events that just tangled up supply chains. Throw in geopolitical conflicts in the Middle East, adding global volatility, surging fuel costs eating into transportation budgets, and persistent inflation making raw goods more expensive. Honestly, by all traditional logic, margins should have been squeezed completely dry.
So, how did they pull it off? Well, distributors cleverly mitigated these risks by shifting their mix toward highly profitable independent channels. Public food distributors realized that independent restaurant operators and specialty channels actually offer higher margins and, surprisingly enough, way more resilience than massive chain businesses. By leaning hard into their scale and service advantages, they actively grabbed market share in these high-margin segments, and that served as a huge buffer against all that macroeconomic noise.
Moving to Section 2, Growth Drivers. Tech and M&A, the industry playbook.
To make this shift happen, the industry basically executed a massive technological upgrade. They aren't just selling more food, they're selling it smarter. We're seeing them implement AI tools to supercharge their sales teams, launch automated ordering platforms for really seamless customer interaction, and just squeeze every single drop of efficiency out of warehouse automation and delivery routes. Because of this, they've structurally lowered costs while making customer service even better. It's wild. Earnings growth is actually outpacing top-line revenue growth simply because their operations are getting so incredibly lean.
But it wasn't just tech. M&A remains a massive core growth strategy. The perfect example, Cisco's mind-blowing $29 billion acquisition of Jetro Restaurant Depot. Sure, programmatic, smaller tuck-in acquisitions have been happening all quarter, but this huge capital deployment, that's a tectonic shift. It proves the major players are more than willing to spend aggressively to capture entirely new market channels.
Which brings us to Section 3, Heavyweights, Cisco and PFG. The Titans expand.
Let's look at that Cisco Jetro deal for a second. It's expected to boost their pro forma revenue by roughly 20% and yield a cool $250 million in net cost synergies. They are clearly aiming to be the undisputed leader in the huge and growing cash and carry channel. Management actually believes that by opening 5 to 6 new stores a year and leaning into aggressive cross-selling, this acquisition will be highly accretive to their earnings per share, literally right out of the gate in year 1.
Meanwhile, Performance Food Group hit a staggering $16.29 billion in sales. They showed massive strength by onboarding new convenience clients. Think big names like Love's and Racetrack. In fact, their convenience sales grew nearly 9% year over year. So they're capturing these massive accounts while simultaneously optimizing their cost of goods sold through some really smart procurement efficiencies.
And the payoff for all that optimization? Well, PFG saw a 7% increase in adjusted EBITDA, hitting $398 million, which actually beat the top end of management's prior guidance. Their organic independent case volume grew 6.5% too. That perfectly validates that strategic shift toward independent, high-margin customers we talked about earlier.
All right, on to Section 4, UNFI's network optimization, shrinking to grow.
Now, UNFI took a totally different route. They actively accepted a 3% sales decline, dropping to $7.9 billion. This was mostly driven by their planned, accretive transition out of their Allentown facility. Think about that. They literally chose to shrink their top line. Their conventional sales dropped 12% because of it. So you've got to ask, why on earth would a major distributor intentionally shrink?
Well, because it pays off directly on the bottom line. Their network optimization shranked operating expenses by nearly 6%, which in turn drove a massive 22% jump in adjusted EBITDA, hitting $163 million. By shedding those less profitable operations, utilizing lean processes, and rolling out high-impact tech, UNFI proved a really important point. Bigger isn't always better. More efficient is better.
Let's pivot to Section 5, Chef's Warehouse Q1 Spotlight, Specialty Surges. Chef's Warehouse delivered an absolute monster of a quarter. They hit $1.06 billion in net sales. That's a jump of 11.4% year over year. Their organic case volume in the specialty category went up 5.7%, and the pounds sold in their center of the plate category, your high-quality meats, rose 6.2%. They're just successfully getting more products into more unique customer locations.
But honestly, the real standout here is their bottom line, a 28.3% surge in adjusted EBITDA to just over $55 million. Their gross profit margins actually expanded by 53 basis points. And no, this wasn't just inflation pushing up prices. This was genuine operating leverage from the investments they've been making in training, technology, and overall infrastructure. CEO Christopher Pappas shed some light on how they pushed through all this external volatility. He noted that their regional leadership basically accelerated their long-term plan, perfectly marrying technology with deep industry know-how to become trusted advisors to the best chefs in the world. They just tuned out the macro noise and executed flawlessly to grab critical market share.
Finally, Section 6, 2026 Financial Outlook, reaffirming the momentum.
So based on these rock-solid Q1 results, all of these distributors have either reaffirmed or actually raised their full-year guidance. Sysco is holding steady, expecting 4 to 6% sales growth. Performance Food Group actually bumped their sales guidance upward, now projecting between $67.7 and $68 billion for the year. And the Chef's Warehouse reaffirmed their strong target of $4.35 to $4.45 billion. You can just feel the confidence across the board.
I want to leave you with this final thought. If these companies can beat expectations during such a turbulent Q1, what's going to happen when all those tech and M&A investments fully mature? If inflation cools down and those global headwinds ease up, even just a little bit, the operating leverage they built could create an absolute powerhouse second half of the year. For investors and operators watching this space, the lesson is crystal clear. Efficiency is the new growth. Thanks so much for joining me on this explainer, and definitely keep your eyes on the food distribution sector.